Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 220th VideoCast podcast for the week ending January 4th, 2024. Welcome, welcome, welcome. We've got a ton to cover, so we'll do a quick photo here and then down to business. This was Caitlin and I, or should I say Lindsey Vaughn and Michael Phelps at a costume bash in Atlanta. Thanks to my buddy Bill V. And this was just an amazing time. Those of you from Atlanta, you might be able to reverse engineer where we were. This New Year's party has been going on for decades and was really a fun time to be part of it. I will say that I was toward the top end to win the contest. I had the flip-flops going. I had everything going on. But a young buck in his late 20s or early 30s decided to one-up me and showed up literally exclusively in a pair of Speedos. And we're not talking about knee length. We're talking about, banana type. Anyway, you get the point. And I give the guy credit because you can't really compete with that. So kudos to him. He won a trip to the Bahamas. And for Caitlin and I, we'll just have to pay our own freight if we want to go to the Bahamas. But absolutely unbelievable way to bring in the new year. And then the Thursday right after the podcast, I joined Kelly O'Grady on Fox Business. The Claim Countdown was amazing. Was exactly 1 year from the last time I joined her on the Claim Countdown. She always fills in for Christmas week for Liz. And we were doing an update on Cooper Standard, among other things. We covered quite a bit on this one. So we're going to listen in now. I want to thank both Jake Mack and Kelly O'Grady for having me on, as well as Liz. It's her show. So here you go.
Joining us now are Tony Zabigala, the Strategic Wealth Partners COO and Senior Wealth Advisor, and Great Hill Capital Chairman Thomas Hayes. Gentlemen, thank you both for being here on this holiday week. Tom, I want to start with you because the majority of the S&P 500 gains, if we get our record here today, which we will keep an eye on, they're coming from the Magnificent Seven. But, there's concern that they could be overvalued, even if we are still expecting to see significant profit increase come earnings season. So I want to get your take. Will we see some profit taking in the market as we head into the new year?
Well, Kelly, thanks for having me. The market's come a long way in a very short period of time. And based on recency bias, people are saying, well, then we must correct 5 or 10% in the first quarter. And it would be natural to get some consolidation or a little bit of volatility. But I wouldn't get too cute with it because we've had 0% gains in the S&P for over 2 years now. We've been consolidating sideways. And it's very difficult to short new highs. I think the opportunity, Kelly, is going to be in the relative value. In a presidential year, the average return for the S&P 500 is about 11.28% since 1928. So that means the Magnificent Seven or the large caps are going to do less well next year than they did this year. And the opportunity is going to be in small and mid caps, which are trading at about 14 times next year's earnings, versus the large caps, which are trading over 20 times next year's earnings.
Yeah, Tom, you make a really good point about the election year as we move forward. All those eyes are going to be on 2024. I am curious to see if we're going to see some profit taking. We saw the European markets, the Nikkei, close down because of that. But, Tony, I want to bring you in because I want to turn to some of these underperformers, right? Mag 7, 2023. Let's look at some of the stocks that could be winners here. I was looking at research from Apollo, and they said 72% of the S&P 500 stocks underperformed this year. That is a record. And so you're advising folks to double down on stocks like Edward Life Sciences, Medtronic. Why?
Yep. So I look at 2024 as the year where 2023 laggards should outperform. And 2024, if we really look at it, could be a challenging year. They're expecting 12% earnings growth and a possibility of a recession. So given those headwinds, it makes a lot of sense to be overweight defensive growth names. Let's take a look at medical devices. Edward Life Science, Medtronic, like you mentioned, they've been dogs this year. And these two stocks right now have a very attractive valuation. So I'd expect them to rebound. And also dividend payers, they've been lagging as well. If we take a look at the Dividend Aristocrat Index, it's only up 7.5% this year. So from a risk-adjusted standpoint, I believe dividend payers and medical device companies to be providing investors, growth opportunities next year, and it's a way to also scale back some of the risk in their portfolio.
Okay, so medical device, that would be one space. Tom, I want to bring you in because I know last time we talked, you were also bullish on essentially, okay, Mag 7, great, but there's a lot of opportunity in those small and mid-cap stocks. I was looking at the Russell 2000. It's up over 14% in December. That's the highest growth that was seen in 3 years. So it does look like there's opportunity there. What are some particular stocks that you're looking at that could be good opportunities for 2024?
Yeah, well, small caps are still well off their highs. And Kelly, the last time you and I were on the Clayman Countdown together was exactly a year ago today. And we were talking about a small stock called Cooper Standard, which is an auto supplier. They do fluid transfer solutions and sealing systems for the original equipment manufacturers like GM, Ford, Stellantis. And we were kind of celebrating. It was up 25% since we originally talked about it to the Clayman Countdown audience in June of 2022. Well, now it's gone from $6.10 to $7.35 when we spoke. Now it's over $20 today. And despite the fact it's up 3x or over 200% now since we first discussed it on the show, we think it's just getting started. With the chip shortage now in the rearview mirror, they've refinanced the debt on their balance sheet, so solvency risk is off the table, and the UAW strike is in the rearview mirror. This company is now turning cash flow positive. You couple that with rates coming down, and the average car on the road is 13.5 years. We're going to start to edge up industry-wide towards production levels that are near pre-pandemic levels when Cooper Standard was earning $7 a share in earnings. They've taken a lot of costs out of the business, so even if you apply a trough multiple to that earnings power in the next 12 to 24 months, we think it's got a lot of upside from here, and we're pretty excited about Cooper Standard.
It's an interesting point that you make about, 13 and a half years. I've been considering getting a new car. It is time to trade my red Toyota Donna, she is named, in, but certainly need to see prices move a little bit there. But Tony, Tom was mentioning rates coming down. Of course, this is something that we have all been laser focused on. The Fed is saying 3. The market is pricing in 6. It looks like those jobless claims that I mentioned at the beginning do show some good movement, some indication that, okay, maybe the Fed will cut rates at some point next year. But I'm also seeing some signs that the economy is still doing well. So my question to you is, should the Fed cut rates? Is it going to be too soon?
Well, the one thing I would say is, fear the cut, don't cheer the cut. Because the market has obviously melted up from when Powell came out and announced that he's expecting 3 cuts next year. And then the market took that information and is now pricing in 6 cuts. So 2 things can happen. They don't cut at all. That would cause what I would feel that treasuries would re-rate and they'd probably go higher. And stocks are not going to like that because they're going to have to finance debt at higher rates. Or they do come out and cut. And how do you cut when unemployment and inflation is relatively low? So at the end of the day, I got to say, just be careful what you ask for, because history shows that the market drawdown is around 20% after the first cut. And there's no reason to think that this time would be any different. Plus, if we start doing rate cuts, think of that as a form of stimulus. And do you think we really need more stimulus right now? So my thought is that the longer for higher is here to stay. And if they're going to be looking at cuts, it would have to be maybe in the second half of the year.
I really like that framing of it as a potential stimulus. I think that's a really interesting point. Tom, I'm going to bring you here on this. Fear the rate, cheer the rate. Last word to you. Got about 60 seconds.
Well, I think the market is ahead of itself with 6 cuts. I think the Fed is behind the ball with 3 cuts. I think we'll wind up somewhere in the middle, probably 4 cuts. And it doesn't necessarily have to be a bad thing for the market. If you look at a mid-cycle cutting like 1995, we had a great stock market and economy for the next 4 or 5 years. And also coming out of that steep hiking cycle of Volcker in the early 80s, when he cut, the market took off and it didn't look back for 18 years. So yes, recent times that they've cut, the market has gone down. But if you look back a little further in history, it could be a very bullish thing if they do it right.
Okay, well, we will see who is right. Tom, happy 1-year anniversary of our first time working together on air. Tony, let's do it again next year. Thank you, gentlemen.
Thanks, Kelly.
Okay, well, we are.
And we're back. And then I joined Ali Sinar on Bloomberg HT, which is the Turkish station, but he films it out of Washington, D.C. Went into a tremendous amount of detail here. We're going to listen in now.
We have a special guest today, Thomas Hayes. He's the chairman and managing member of Great Hill Capital. Tom, welcome to Bloomberg HT.
Thanks for having me, Ali.
Fed expects at least 3 interest rate cuts in 2024. So what's your expectation for next year? What kind of actions or steps will Fed will take? Your overall observation and feedback.
Yeah, I think there's a wide spread right now between what the Fed expects they'll have to do in cuts, as you referenced on the dot plot, around 3 cuts, versus what the market expects the Fed will have to do, which is around 6 cuts. You know, right now they're highly restrictive. If you look at the Fed funds rate at 525, 550, minus the core rate of inflation, they're probably 200 basis points too restrictive. So I think they'll have to come down probably less than the market thinks, but more than they think is a reasonable assumption, working assumption moving forward.
As you know, Tom, there's a big discussion on recession, a lot of discussions this year. So do you think right now we are not going to see any recession next year? What does the U.S. macroeconomic outlook look like for 2024?
Yeah, well, I think so many people spent 2023 waiting for the recession that already happened in 2022. If you remember, the first quarter and the second quarter of 2022 were negative GDP prints. You had a tech spend recession, and then you had some rolling recessions with manufacturing and other sectors over the last 24 months. So I think that's now largely in the rearview mirror. I think as we look at earnings growth going into 2024, which is what the stock market trades on, we have 12% earnings growth. But the real magic and the real story that very few people are focused on is because everyone was preparing for a recession that never came, they cut a lot of costs and started to run their businesses more efficiently. And I think the real story for 2024 is going to be margin re-acceleration of 60 to 70 basis points, which is going to take everyone by surprise with increased productivity, increased technology, lower costs, and an economy that is starting to recover. So despite the fact that we've moved a long way in a short period of time for the general indices in the last handful of weeks, you have to keep in mind that largely for the S&P 500, the returns since 2021 have been 0. So just now breaking out to new highs, I think there is some runway in 2024 and beyond.
And Tom, when we look at Middle East right now, there is a lot of going on. Do you think the geopolitical developments, especially in the oil industry and gas, would have impact on U.S. economy next year?
Well, there's always geopolitical risk. I do think they are slightly elevated at this point in time. And I think that's probably why the Fed will have to cut less than the market thinks, but more than they think. I do think you could probably start to see a bid in oil as we get towards the end of the first quarter and into the second quarter. And that's going to keep inflation probably slightly above trend and maybe not moving down as aggressively fast as the 6 cuts are pricing in the Fed funds futures. And as a result, the Fed will in fact just be able to do 3 or 4 at the most. But by and large,
the geopolitical risk is always present, but it's not going to impact the amount of generators that Generac sells, or the amount of total volume processing that PayPal does, or the amount of new cell towers that Crown Castle does. I think that's a regional conflict that may create short-term volatility for the energy markets at certain points throughout the year, but by and large should remain relatively contained.
And Tom, when I look at past 6 weeks right now, Dow Jones, S&P 500, the stock was doing really good. So what is the stock market outlook for next year, your expectations?
Yeah, so many people are now calling for a correction because we moved too far too fast. I wouldn't get too cute with that because, again, we've been consolidating sideways for 2 years. And secondly, as you look at a presidential election year, there's going to be a lot of fiscal spending coming into the market. On average, since 1928, the average returns for the S&P in an election year are just over 11%, 11.28% on average. And in a year that a sitting president is running for re-election, they're closer to 13%. So we're looking for high single-digit, low double-digit gains in the general indices, which implies that large caps will do less well than they did in 2023, but still do okay. Think the Magnificent Seven. And the opportunity is going to be in the relative value, small caps and mid caps trading at 14 times next year's earnings versus the large caps and the indices trading at 20 times. I think you got to be selective, and I think there'll be great opportunities under the surface to take advantage of.
Is there any specific industry stocks for next year that, maybe rising a star, especially when we look at the technology stocks?
Yeah, I mean, as far as technology, we like the fintech area. We like PayPal. This stock has been beaten down 85% off of its 2021 highs. They have a new CEO in Alex Chris, who came from Intuit. During his tenure there, he was responsible for 50% of the revenues. The stock was a 35 bagger, which means if you had put in $1 million, it became 35 million. He's come to PayPal to turn the company around with the same strategies, and he's going to turn it back into a growth company from a value company. It's currently trading at 12 times earnings. It's historically traded at 30 times. I think as rates come down and as margins go up for the Braintree division, which is the global enterprise processing business, the stock is going to get re-rated. You're going to get multiple expansion. That can be up 50% plus. We also like Cooper Standard is a major holding for us. They do the sealing systems around the windows and doors, the rubber sealing systems, fluid transfer systems, fuel delivery. They provide parts to the original equipment manufacturers, think GM, Ford, etc. And I think as rates come down, you're going to see a reacceleration of people wanting new cars versus used cars, because used cars, the rates are still elevated. And the average car on the road is 13.5 years. So they're just slowly getting back, trying to work towards pre-pandemic volumes. Probably another 12 to 24 months to get up to those levels. But the operating leverage in an OEM supplier like Cooper Standard can be phenomenal. And we think they're going to benefit immensely, despite the fact they've moved up considerably since we've gotten into the stock. We think it can move up even more over the next 12 to 24 months.
And I want to come to the crypto stocks, Tom, especially in the United States, and White House made some statements. They want also action, especially from the US Congress, have a strict regulations on the crypto business. So what is your expectation? How would impact on stocks when you look at some crypto stocks?
Yeah, we don't traffic in crypto stocks. We tend to focus on productive assets that generate free cash flow. But generally, the bullish narrative from the crypto community is that they're going to have a halving. And every time they have a halving, which reduces supply or makes it more expensive to produce it, historically, the coins have gone up in value. And there's expectation that there may be an ETF, which would give access to a lot more people, in which case you should see continued demand, but that's not an area that we play in, despite the fact that it could continue to perform potentially, and a lower rate environment generally helps all risk assets, and that would include crypto. But again, not a space that we play.
Credit conditions seem good, but it seems like it won't continue given the higher interest rate. What do you assess on the corporate credit conditions for next year?
Yeah, it's very interesting what a difference a year makes. Fall of 2022, there was real default risk particularly in the high yield companies that were trying to refinance their debt. Now, with the expectation of the Fed getting out of the way and starting to ease in 2024, you are seeing spreads come in. You're seeing companies' ability to refinance their debt expand. And I think the theme for 2024 that no one's really paying attention to in their models is not only are companies going to be able to refinance and remove solvency risk, but they're going to be able to refinance at lower rates, which is going to increase the earnings power moving forward. So I think that this is an underestimated tailwind for markets, for earnings, and for companies in 2024 and beyond. The ability to get access to capital in the credit markets and to get it at lower costs will be a boon for the market.
Mm-hmm. And what is your 2024 message to the business world, Tom? This is my last question.
Yeah, I think the message is there's reason to be optimistic. We expect high single-digit, low double-digit returns in the S&P 500, but there are tremendous opportunities from the vast majority of companies in the S&P 500 that are not the Magnificent Seven that have really just begun to participate in the rally and started to come off very, very low valuations. So I think that while the general indices will be subdued, there will be a tremendous amount of opportunity to make money in 2024 and beyond by selecting the right businesses on a case-by-case basis.
Tom, thank you for your time, and Happy New Year to you.
Thank you. Happy New Year, Ali.
And we're back. So that gives you the general overview. And finally, I want to thank Annie Palmer for including me in her article on CNBC about buy now, pay later last week. And moving right along, we've got a fun way to start this week. And this came in as a great AMA from Matt Mahler, Mahler. Hello, Tom. Belated Merry Christmas and Happy New Year to you and your family. Thank you for all the opinions. I've learned a great deal over the past couple of years studying your YouTube videos. I'm currently reading Peter Lynch's One Up on Wall Street and thought of you and Baba when I read page 266. Quote, "It's taking too long for anything to ever happen." I think it would be a good share on one of your videos. Keep up the amazing work. All the best, Matt Mahler. Well, thank you, Matt. We're going to do exactly that. So this is from Peter Lynch's One Up on Wall Street, and I'm going to do it in the context of another book that I've recently read, which I'll tell you about in a minute. But here's what Peter Lynch had to say in his excerpt, "It's taking too long for anything to ever happen." Here's something else that's certain to occur. If you give up on a stock because you're tired of waiting for something wonderful to happen, then something wonderful will begin to happen the day after you get rid of it. I call it the post-divestiture flourish. Merck tested everyone's patience, see chart. This chart went nowhere from 1972 to 1981, even though earnings grew steadily at an average of 14% a year. Then what happened? It shot up fourfold in the next 5 years. That's 300%. Who knows how many unhappy investors got out of Merck because they were tired of waiting or because they yearned from some more action. If they had kept up to date on the story, they would not have sold. The stock of Angelica Corporation, manufacturers of career apparel, hardly budged a nickel from 1974 to 1979. American Greetings was dead for 8 years. GAF Corporation for 11. Brunswick the entire 1970s. SmithKline before Tagamet for half of the 1960s and half of the 1970s. Harcourt Brace through Nixon, Carter, and the first Reagan administration, and Lukens didn't move for 14 years. I stuck with Merck because I'm accustomed to hanging around with the stock when the price is going nowhere. Most of the money I make is in the third or fourth year that I've owned something.
Only with Merck, it took a little longer. If all's right with the company and whatever attracted me in the first place hasn't changed, then I'm confident that sooner or later my patients will be rewarded. This going nowhere for several years, which I call the EKG of a rock, is actually a favorable omen. Whenever I see the EKG of a rock on the chart of a stock to which I'm already attracted, I take it as a strong hint that the next major move may be up. It takes remarkable patience to hold on to a stock in a company that excites you, but which everyone else seems to ignore. You begin to think everybody else is right and you are wrong. But where the fundamentals are promising, patience is often rewarded. Lucan stock went up sixfold in the 15th year. American Greetings was a 6-bagger in 6 years. Angelica, a 7-bagger in 4. Brunswick was a 6-bagger in 5. SmithKline was a 3-bagger in 2. And here's that Merck chart he's talking about. Earnings up steadily from 1972 to 1981, despite a lackluster stock price, and good sign to hang in there. I did, and it was worth it. So he shows earnings relative to price. Earnings are going up, price is going nowhere, and then all of a sudden, boom, it just goes straight up from 12 to 70 over 1 year's time period. And these stories are the same. And we have a similar situation, obviously, in Alibaba. It's gone nowhere since 2015, or actually since it IPO'd in 2014. Earnings up, 500%, cash flow up 500% per share, sales up 800% per share. And these are the type of consolidations before you get massive takeoffs. Another great story which reminded me of this, Kevin and Matt Mailer, thanks for making that contribution. That was phenomenal. I've read this book, but it's been a while, and this is a perfect story. This is all part of my DNA after years of reading this and living this, but for many new people learning the business, this is great. This is a book that blew my mind. It's called The Fish That Ate the Whale, The Life and Times of America's Banana King. And this was a story of Sam Zemurray, written by Rich Cohen, who, by the way, I had heard his name because a good long-term poker buddy of mine, we've been playing once a month for 15 years, is good friends with him, and Rich actually lives in town. So I may wind up just having to meet him for coffee or lunch or something like that, because this book was absolutely phenomenal. And I want to read his other books. He's written quite a few. So that's that. But let me tell you about Sam Zemurray, for those of you who don't know the story. He was born in 1877. He was nicknamed Sam the Banana Man, and he was an American businessman who made his fortune in the banana trade. He founded the Cuyamel Fruit Company and later became president of the United Fruit Company, the world's most influential fruit company at the time. Both companies played highly controversial roles in the history of several Latin American countries and had significant influence over their economic and political development. So he was born in Russia, born to a poor Jewish family in Kishinev, Bessarabia, Russian Empire, present-day Moldova. His grandfather, Mendel Hirsch of Shargorod, was a musician and band leader. Zemurray grew up on a wheat farm. After his father died, he emigrated to America with his aunt in 1891 at the young age of 14. After landing in New York, he settled in Selma, Alabama, where his uncle owned a general store. Zemurray worked many odd jobs during his youth, being a carpenter's assistant, a delivery boy, a traveling merchant, and a house cleaner. Eventually, he saved enough money to bring his siblings from Europe to the U.S. Zemurray encountered bananas for the first time in Selma in 1893. At the time, bananas were considered new and exotic delicacy in the United States, and the industry was growing quickly. Zemurray went to the port of Mobile, Alabama in 1895 to enter the banana trade because bananas ripen quickly. The banana trade relied on the ability to quickly bring the product to market. In Mobile, Zemurray specialized in buying cheap bananas in danger of being overripe and quickly transporting and selling them in the surrounding region by rail. Starting with only $150, he saved $100,000 by age 21, buying these almost ripened, which were considered trash in most areas because they were going to go stale before they could get them to the vendors and the grocers. His success earned him the nickname, quote, Sam the Banana Man. In 1903, Zemurray signed a contract with United Fruit, the dominant company in the banana trade, along with his partner, Ashbel Hubbard. Remember that name, Ashbel Hubbard. The newly formed Hubbard-Zemurray company would buy and distribute United Fruit's ripest bananas. United Fruit itself bought a portion of the Hubbard-Zemurray. In 1905, Zemurray moved to New Orleans and the company acquired Thatcher Brothers Steamship Company. They also acquired the Cuyamel Fruit Company and started using that name for the company. At this time, the company imported bananas from Central American farmers but did not grow bananas on their own. This changes in 1910. Zemurray bought 5,000 acres of land along the Cuyamel River in Honduras near the town of Omoa. He then continued to borrow money and borrowed more to buy more lowland forest land in Honduras, well suited for growing bananas. He developed this land by adding plantations, railroads, and bridges. The work was done largely by Jamaican workers, but Zemurray also liked to participate in the physical labor in the fields himself. As a matter of fact, he traveled across the whole country, Zemurray, on a mule. There's some funny stories about that in the book. As you know, mules are stubborn, so it would leave him in the middle of the lake, middle of ravines and all kinds of stuff, and all the different things they faced with scorpions and mosquitoes and everything else that many workers lost their lives. At this point, okay, so here's what happened. At this point, Hubbard believed that Cuyamel Fruit Company's debts had grown too large, and Zemurray bought his share of the business from him. Okay, so that's the overriding story. Here are the details from the book. So I just read to you from Wikipedia about Zemurray. Now I'm going to give you some details that notes that I took from the book. So Zemurray took this partner in 1903. This was out of character for Zemurray. He was a solitary sort, a late night walker, and a party avoider. This guy was, serious as a heart attack. He didn't have time for fun. He liked to make decisions on his own, better to ask forgiveness than permission. But he had gone as far as he could go with the ripe bananas. He wanted to move to the more respectable precincts of the trade, where the real money was. For this, he would need capital and help, someone to kick in the cash and tend to the office while he traveled. Ashbel Hubbard, that's the name I told you to keep in mind, is gone now, dead, buried, and forgotten. No shadow, rumor, or trail. If his name survives, it's a footnote in the story of Zemurray. He was a poor bastard who lacked the nerve, who sold out too early, who quit the game a minute before the number came in. Let me repeat that. Zemurray's partner, Hubbard, was a poor bastard who lacked the nerve, who sold out too early, who quit the game a minute before the number came in. So Hubbard was a product of the scene, having grown up in Mobile, a sort of elder statesman respected by everyone in the trade. In him, Zemurray would have recognized a member of the club, a mild-mannered man who could reassure investors concerned by Sam's risk-taking. Hubbard also had his own contract with United Fruit, which also helps explain the partnership. In Zemurray, Hubbard would have recognized the raw talent of a rising star. They joined with an ambitious goal to traffic yellows and greens. So yellows were the ripes, greens were the high-end stuff that would last a long time before it got to the store, which Zemurray and Hubbard would import to Mobile, New Orleans, and Galveston. For Sam, who had always kept costs down, this meant assuming a new level of risk. The Hubbard-Zemurray company started with $30,000 in capital. Okay, so this is 1903, $30,000 in capital. They rented an office, et cetera, et cetera. Now, fast forward, Zemurray bought his first parcel of land on the edge of Omoa, an old colonial town on the north coast of Honduras. Much of the property ran along the southern bank of the Cuyamel River, where the country is hilly and fine, 1,000 shades of green. This was long considered junk land, neither valued nor tended. for $2,000, all of it borrowed. He got 5,000 acres. He was soon back in New Orleans wondering if 5,000 was enough. Would it give him the supply he needed to compete with United Fruit? And, quote, "It does not matter if you think it's enough," Ashbel Hubbard told him, that's his partner. "We're out of money. There are times," now listen to this, "there are times when certain cards sit unclaimed in the common pile, when certain properties become available that will never be available again. A good businessman feels these moments like a fall in the barometric pressure. A great businessman is dumb enough to act on them even when he cannot afford to." So this is very important. So his partner was bitching. He just got 5,000 acres for $2,000 in 1903 in prime growing region, but it wasn't considered prime because there wasn't the infrastructure in place, but the climate and the location was ideal. But Zemurray instinctively knew, and like all good business people, like all good investment, quote, "There are times when certain cards sit unclaimed in the common pile, when certain properties become available that will never be available again in our business at a certain price. A good businessman feels these moments like a fall in the barometric pressure. A great businessman is dumb enough to act on them even when they cannot afford to." Now, we're anti-leverage. This guy was a bit of a cowboy, but it's the same instinct that yields greatness. The first shipment was followed by a second, a third, and a 15th. It's one of the great things about bananas. Unlike corn or cotton or tobacco, they have no season or one season that lasts forever, an endless summer broken now and then by a hurricane or a drought. The winter, the frost, the early darkness, the first flurries, that's another world banished. Planted correctly, a banana plantation is a never-ending bounty. Zemurray began scouting for still more property, which would mean more rails, more workers, more houses, which would require more money. He was already overextended. He had taken loans from banks across America. When he realized no creditor would lend him another dime, he went in search of other sources. He knew he had a gold rush. He knew that if he could buy up all this land before people realized it was valuable, then when everyone realized it was valuable, some years in the front, he could lay it off. Now, when he realized no creditor would sources. So if you were Zemurray, an entrepreneur at the key moment when you just knew you had to risk everything. We don't endorse risking everything ever on one idea, but in this case, he just had that instinct that this was the time and the place, that this was your shot, but the banks had turned you down and your money was on the table and you had neither wealthy uncles nor elite contacts. Where would you go? The history books and articles say he secured the needed funds from unorthodox sources, borrowed on stringent terms at rates approaching 50%, which of course means gangsters, wise guys in flashy suits on the corner of St. Claude and Dumaine. I mean, he was going for it. Ashbel Hubbard had agreed to the first round of bank loans and land purchases and had agreed to the second, if less enthusiastically. But this was too much for old Ashbel, whereas Zemurray thought everything should be risked now at this specific time while the opportunity presented itself. Hubbard believed the business should be given some time to become established. In other words, Hubbard wanted to wait for the stock price to double before he got in. He was looking for certainty, and that yields missed opportunity. First, plant the land we've acquired, pay off some loans, then we could think about acquiring more acres. But Zemurray must have realized the business had to get big to survive. Go all in or get out. Sam was young and wanted to bet everything. Great fortunes come from big plays. Hubbard did not have the fortitude for such risks. He had become a nervous partner who considered the actions of Zemurray worrisome. So here's the net effect. Zemurray basically bought him out. And let me get you the exact number here, because I'm missing that. All right, so, okay, so Here's the deal. When Hubbard couldn't take it anymore, Zemurray agreed to buy out his share of the company, a 45% stake in the Cuyamo Fruit. This left Zemurray with 90% of the company and United Fruit with the remaining 10%. The terms of the deal were never reported, but the company was valued at $400,000, meaning Zemurray paid something like $160,000 of money that he surely borrowed from the same nefarious characters who lent him all the money. What was Sam thinking, piling on debt, risk, and risk? By buying out Hubbard, he was taking it all on his own shoulders. But what did it matter? If he failed by himself, he would lose the exact same amount as if he failed with a partner, which was everything. So here's a guy who basically, they started this business with $30,000, probably Hubbard's money. He probably brought the labor. Hubbard probably brought the capital. That $30,000 became worth $400,000. So Hubbard took out his more or less half, which amounted to $160,000. And Hubbard was out, okay? So not a terrible deal for Hubbard. Let's just call it, let's say he put up 50% of it, he made 10x. More likely he put up 100% of the capital, he made 5x, okay? But he got nervous when the thing was growing. He couldn't take the heat. They weren't making money because they were reinvesting it all. So he just said, let me take the sure thing and get out. And here's how it turned out. Going back to the original sentence we started with, Ashbel Hubbard is gone now, dead, buried, and forgotten. No shadow, rumor, trail. If his name survives, it's as a footnote in the story of Zemurray. He was a poor bastard who lacked the nerve, who sold out too early, who quit the game a minute before the number came in. So what does that mean? What does that mean? Well, here's what it means. Yes, he got a 10-bagger, let's call it, on his capital, but he owned basically the same as much as Zemurray did. Well, Zemurray stuck with it, and Zemurray died on November 30th, 1961. He was 84 years old. His fortune was estimated at $30 million. And his obituary was carried on the AP wire that said, quote, Sam Zemurray, former president of the United Fruit Company, who came into the United States as a penniless Russian immigrant and accumulated $30 million fortune selling bananas, died here last night of Parkinson's disease. Quote, in the banana belt of the Caribbean, Sam Zemurray was known as the fish that swallowed the whale. So what does that mean? $30 million fortune doesn't sound like a lot of money today. But in today's terms, that's worth $308 million. So what did Ashbel leave on the table by quitting at the exact wrong moment, a minute before his number was called? Well, he got $160,000 in his pocket. That was the sure thing. He would have had $30 million, which is the equivalent in today's terms of $308 million. So by taking the sure thing, he wound up with $160,000. So you could say, oh, well, that's still worth $1 million in today's terms, which is chicken feed. Instead, he would have had $308 million, just like his partner who had the same, or at least 15 million of that. So Zemurray actually wound up with his interest. So he would have wound up with about $15 million, and instead he had $160,000. And that $15 million would have been worth $150 million in today's terms. So that just leads me to situations like Peter Lynch was referring to about Alibaba and this poor bastard who quit right before the finish line and wound up with pennies instead of a fortune. And literally he went through all the hell of laying down the rails, buying the property, dealing with the workers, all the headaches right before Zemurray had the big break and left $150 million on the table. So foreign purchases of China stocks. So this reminds me a lot of China, because this is the instinct of what they're talking about. Came up too early. Zemurray's instinct There are times when certain cards sit unclaimed. If China, highest quality China companies with 1.4 billion people and still growing GDP at 5%, and all because of a 1 in 100 year event, both in terms of policy and in terms of pandemic, and response to pandemic, these cards are sitting unclaimed in the common pile, where certain properties become available that will never become available again at certain prices, similar to Cooper Standard last year, similar to energy companies in 2020 and banks in 2020, or Rolls-Royce last year. Peter Lynch talks about, and Intel at 25, and all the other companies that we've talked about over this podcast. There are times when certain cards sit unclaimed in the common pile, when certain properties become available that will never be available again. A good businessman feels these moments like a fall in the barometric pressure. A great businessman is dumb enough to act on them even when they can't afford to. So this guy went, all in, levered long. I think that's, in our business that you can't do that because you got to live to another day. But even if you put a sizable thing, it can change your life. And you could still live by the rule that any position you ever put on, you have to say to yourself, there's a possibility there's something that I don't know that I don't know. If this position went to 0, would they take me out on a stretcher? And if the answer is no, from the remaining 8 positions or 9 positions, I could still, over 3 years, generate an above average IRR or compound annual growth rate for clients. Even with this at a 0, then you lean into that position, you lean in hard, and you don't let it go, even when the pessimism is against you, particularly when you've done the work and you know the asset, and they're growing cash flow and growing earnings and growing revenue in the most hard circumstances in history. So I wanted to point this out because this was in the Financial Times today. Foreign purchases of China stocks dropped to 8-year low in 2023. So, pessimists look for the difficulty and the opportunity. Optimists look for the opportunity and the difficulty. What they didn't note was the fact that the last time foreigners fled China this aggressively was 2015. Well, I overlaid the Alibaba monthly chart to 2015, and over the next 24 months, Alibaba went from $56 to $208 in 24 months. So you had a 4-bagger when everyone was running for the hills, when Ashbel Hubbard was hitting the window and taking his $75 a share and quitting right before Zemuri held out and wound up with a 4 or 5-bagger. Plus, and this is the same thing you see over and over, and Peter Lynch referred to in all of those stocks. The good news is we don't have to wait a decade like Charlie Munger did with BYD before he had a 16-bagger in 2 years. Most people don't know that. He's known for BYD, which they got in like 2009. It didn't take off till like 2020. As a matter of fact, maybe I'll just pull up the chart here. BYD. All right, one of these should work. Yeah, so I first remember hearing about this at the annual meeting somewhere around, I think it was 2011, so maybe around $10 or something like that. And I remember shortly thereafter, the stock fell, from where Charlie bought it, fell about 75%. And I'm like, my goodness, Buffett must not be too happy with him because this was his big idea, down 75%. But they were patient and they stuck with it and they knew what was happening with the business. And from that 75% drop, then you saw over the years, it did nothing for a decade. And then all at once, it went from 8 to 80 in about 12 months. So nothing for 10 years, 10-bagger in 10 or 12 months, and a 10-bagger over 10 years is going to be, any, type of situation. So that's the level of patience. And here's the other thing. It didn't just crater 75% once. It cratered a third here, cratered a half here. Then right before it did its final 10-bagger, guess what? It cratered 60% again from 2018 to 2020. So, and then you get your 10 bagger. So, and by the way, they were laying off at the 10 bagger. So, there's a reason that they became billionaires investing, because they are in the business of picking up unclaimed cards, number one, and number two, not quitting 1 step, 1 minute before your card is called. What is that saying? Quitting the game a minute before the number came in. So I hope that's helpful. And I want to thank Matt Mailer for sending that, because the Peter Lynch kind of sparked the thing, and it just kind of synced with the Sam the Banana Man story from Rich Cohen's The Fish That Ate the Whale. All right, moving right along. Speaking of which, everyone's afraid of Alibaba because of Temu. Well, you can see Temu's users peaked. At the end of the day, when you sell goods at a loss for a long enough period of time, it stops working. Same thing with Shein. So those are going to be flashes in the pan. But the good news is Alibaba's picking up some of their best techniques and adopting them quickly. It's the same thing that always happens. You get these new up and runners, and if you can't buy them and shut them down, you just copy them because you have greater resources, greater infrastructure, etc. Behind the cheap stuff from Shein and Temu, a hard bargain with suppliers. Shopping apps throw a lifeline to Chinese exports, but that's a trade-off. Some suppliers spoke with the Wall Street Journal, said they were grappling with razor-thin profit margins and intense pressure to cut prices. Others said they were drowning in unsold inventory and were questioning whether dealing with Shein and Temu would be sustainable in the long run. Well, let me save you your thought process. The answer is no. So there you go. Singapore hedge fund says Hong Kong stocks are a, quote, once-in-a-lifetime chance for big upside after wildest 2 years since 2008. So this guy, maybe we're going to start to use these names, is a Zemuri, not a Hubbard, and he gets it. And he said the risk reward is the best I've seen in 40 years of investment and trading. I couldn't agree more, by the way. And this interactive chart at SCMP, South China Morning Post, goes through all these different things when the market was up and down and what was the headline at the time. It's kind of comical to see it. It just repeats over and over and over. This is where I got that foreign purchases of China stocks dropped to 8-year low. Okay, Alejandro Arevalo, said head of emerging market debt at Jupiter Asset Management in London, was encouraged by comments from the government that it was increasingly willing to intervene to support the economy. We believe we have seen a bottoming out in Chinese markets and sentiment, and therefore expect to see some improvement as the year progresses. Optimists realize... okay. The China stock market... Others like JP Morgan's Liu is undeterred. While clients might prefer something concrete from Chinese policymakers to justify snapping up undervalued shares, she said that from experience, quote, the best buying opportunity is when there are no catalysts. This is really interesting, and I've never heard it put it that way, but this actually ties back to what Peter Lynch is saying when the EKG looks like a rock. When it looks like the EKG of Iraq. And basically, that's what we've been seeing. This EKG has just been going sideways, doing absolutely nothing, just like in 2015 and early 16 when everyone was running for the hills right before an immediate 4-bagger, 300% gain over 2 years, followed by a subsequent, what turned out to be a 6-bagger if you held to the peak in 2020. So that's that. China services sector expands in December, private surveys show. So that was better than expected. And back in expansion, things are turning up. China's commodities demand remains resilient despite factory slumps. So services were good, manufacturing was weak, but that's what they're trying to accomplish. is consumption-based economy. Cheap China stocks lure investors who see 60% slump as rock bottom. Almost a third of survey respondents say they will increase their China investments over the next 12 months. So this yellow is the ones that want to increase. The black is the ones that want to decrease. Next, Alibaba Cloud looks to spur growth via shift from government clients to public cloud services. That's from December 29th. Taobao aligns refund rules with Pinduoduo in an attempt to draw in users, so they're just going to rip them off. By the way, you say, well, then they're not as good. Why do they have to rip them off? Well, look, Bill Gates became the richest man in the world by ripping off the software from what was basically IBM. Zuckerberg has done it over and over and over. He ripped off Snap's stuff. He ripped off his friend's stuff in the dorm room. He just rips off anything that's good and implements it better. He's better at execution, so we're counting on their ability to execute. And with all the turnover, they probably got the right butts in the seats at this point. They can't make any more changes. They also completed the process of removing Jack Ma's control of Ant. That sets them up to get that IPO. And by the way, I think it would be perfect poetry to see that the crisis began with the scuttling of the IPO and ends with the issuance of the IPO of Ant Financial. We'll see how that plays out. I love this headline. The dollar is set for its worst year since 2020. When we were talking about this, no one believed it would be the case, and I think that's going to persist. And we're going to talk a little bit. I think that the Fed is actually going to move earlier than I even thought a week or two ago, looking at some of the numbers over the long weekend. Biotech stocks were tanking the Cure M&A, so now that's finally taking off after being dead money. Again, we just pick up these unclaimed cards, and in a couple of years, everyone's going to be begging us for these cards, and we're going to lay them off. Online holiday spending reaches a record $222 billion, driven by buy now, pay later options. The article I was in for CNBC, the lady was writing, Annie Palmer was writing about Affirm, and I said, look, Affirm is toast. It's David against Goliath, and Affirm is and Goliath is going to win. Affirm doesn't have the large other businesses to support. The buy now, pay later is a mediocre business, but PayPal can dominate by doing it right and having the resources to do so. And they had a huge advantage in Q4 where this method of paying went well, and everyone's worried about the defaults. Well, people will default. Yes, they will default, probably 10%. The problem is when you're charging 24%, you can afford for 10% to default, and it's still an incredible business. Just ask the credit card companies. They're doing just fine. Buy GM stock to play the EV strategy and falling rates, says analysts. I agree with the latter, not necessarily the former. Record auto sales last year, so that's good for Cooper Standard. We'll see that in the earnings call in February. And then Seth Golden here on Twitter. The last time the summation index cycled from negative 800 to positive 1,000, with S&P delivering negative annual return was, quote, never. Since 1988, it's happened 6 times. So when you go from this extreme oversold to extreme overbought in a short period of time, on average, the next 12 months, you were up. Every single one of these was basically mid-20s to 30s. So call it mid-20s average. I don't think we're going to get mid-20s for this year. But I think we are going to get double digits, and we just had that cycle through. So that's interesting. So while everyone's saying, well, we're overbought now, we have to crash. Yeah, we can consolidate. We're not going to crash. Looking a year out, it bodes to very good things. Good to remember that the average peak to trough correction per year is 14.2% since 1980 for the S&P 500. Last year, stocks had a 10.3% correction and still gained more than 24%. Takeaway is even in strong years tend to see some scary moments. So yeah, it's totally conceivable. We could see a 10% correction this year, maybe even a 15%. But after 2 years of having big corrections, 25% and then 10%, usually you get a more muted thing. But we'll take a look at the roadmap in the article of the week, and I'll kind of give you my 2 cents on that. Now, small and mid caps. Ryan Dietrich also put this out. Russell gained 21.9% in the last 2 months of the year. Forbes 2-month gain, fourth best 2-month gain ever. Looking at the previous 10 best 2 months gains, showed higher a year later 9 times and up 26.9% on average. And that's why we've been pounding the table on small caps now since the fall when you couldn't give them away. Yes, they've had a big move, and yes, I think they've got more room to run, and history actually supports that empirically, on average 27% for the next 12 months. Hedge or no hedge stock market and sentiment results on by the way, I have updated this article since I published it this morning to include excerpts from the Canada Goose earnings call. So you'll want to revisit the article. Everything else is the same, but I just added another 20 images. Okay, so Fox Business, you already went through. Bloomberg, we went through. Now, as stated in the media appearances above, while we do expect some consolidation volatility in Q1 after a nice move in Q4, we would not get too cute with shorting or hedging, as it's tough to short new highs. There are still bargains to be found if you look carefully, but certainly an environment to hold. We do not sell or hedge stocks on the basis of market timing. We sell stocks when they have reached our estimate of fair value, which we determine before we enter the position. As Sun Tzu said in The Art of War, quote, "Every battle is won before it's ever fought." Here is some example of 2-year consolidation, little check back, 2-year rally, 2-year consolidation, check back, 2-year rally, 2-year consolidation, 1-year rally, 1.5-year consolidation, breakout, another 1.5-year rally. And then here we've had 2 years of basically no gains. We're just breaking out. Could we check back to, that wherever that is, 4,600 where it broke out? Certainly we could. But to play for 100 points, 1,000 points on the Dow, I don't think it's going much lower than that. It certainly could. But what I do know, like if you look at this after this parabolic move off the lows in 2020, you had a few months of this sideways chop. It felt like the end of the world. Same thing in 2019, same thing in 2016. But to short here, all you're doing is getting trapped in the recency bias. You're looking back to here because that's all you know is the last 2 years of a lot of false dawns. So to play and get cute for this little tiny move, which may look like a lot on the P&L in the short term, it's really not worth it, because if you're out and it takes off without you, and I think we can do that particularly on our holdings, because the move now is going to be Mag 7 more subdued, indices 10%, which is their weighting, and underneath the surface, the ones that are just starting to play catch up in the last few months really start to accelerate. We don't want to be out of any of those. Now, what do you short? I mean, do you short the Mag 7 into that? I think it's just getting too cute. I think if we push higher, and this is what I wanted to show you, this is the election year historical performance. But the distinction that Fundstrat makes here, which I love, is you normally look at the election year and you say, oh, it's a crappy first 6 months, like sideways grind, chop, basically no progress until June. And then the second half of the year, you get the gains, which are, on average up 11.28% since 1928. But he makes a subtle distinction, which is critical, which is that election years after a 10% gain in the previous year, meaning you have momentum coming off a big bottom. This is since 1950. And what happens is you get this chop in the first week of January, and then you get that rally to, in our case, meaningful new highs. And then towards mid-February, you get this strong correction into March. And my general view is, rather than hedge out now just to deal with some short-term volatility, if we get some exuberance in January, February, meaning we push to meaningful new highs, which just forces the last few holdouts in, and Mike Wilson puts out a brand new note where, triple break putt to the upside, all up, and thing takes off, then I think here we would probably start to put not hedges, but some asymmetric, aggressive shorts on, with premium, with expected values of 3 to 5x for us to be willing to take the short risk to play that short-term tactical move, which would basically hedge out so we don't have to sell anything that's not yet at full value, but we could actually make money on the downside. So the asymmetry, despite many of the indicators being overbought and et cetera, I think there's a little more juice to squeeze out of this just because the cash levels are still where they are. We covered a lot of that last week. You should go back and take a look at that under commentary here on hedgefundtips.com. While you're there, go to terms. This is all opinion, not advice. Consult your financial advisor before doing anything. We deal exclusively with accredited investors. We don't know what your situation or risk parameters are. Okay, so this is kind of our base case. I'd like to see some really shocking push things through. Now, what could be the catalyst of this? Potentially the jobs report tomorrow might have some impact, but I think more importantly are going to be the inflation numbers on January 11th. I think what they're going to show us is on an annualized basis, we are at the 2% target, and then the Fed has to panic into starting the cuts, because if they get into deflation, they can't afford to get us out. Inflation is easy to solve. Deflation is very costly and could be devastating. So it's going to force their hand sooner rather than later. And if they do it sooner, they may have to do less cuts than everyone anticipates. But if they wait, it's going to be more and it's going to be costly. So this is also Fundstrat's view of when you have a sitting president running, which is the green line, you get that rally into February before the weakness into March, which basically creates some flatness through June. And then the second half is where you get those high single digit, low double digit. But I think we want to push higher here for the next 4 to 6 weeks, maybe catalyzed by the CPI, maybe catalyzed by the jobs report, maybe catalyzed by earnings. We got bank earnings starting next week. So I think all those things will be good. Expectations are low. Could push the market a little bit higher, and then we start to roll over into March, and that'll be an ability to take some selective shorts and pick up some real tremendous additional value. So we'll definitely be taking advantage of that. Stocks have never been lower in an election year under a new president. So average is 12.2%, which is right in line with the average for an election year since 1928 of 11.28, and everything else that we've been covering. Last shall be first, part 2. Bespoke put every single asset class here. We drew a keen eye to those groups that did the worst for opportunity. Looking through the asset classes, our eyes are trained for opportunities. Last year's laggards, meaning natural gas, which we talked about Comstock last week. Go ahead and review that. Many of these we've already implemented. Long bonds, those took off from last fall. Emerging markets, but by the way, finished positive. If you remember, in the summer when everyone was bearish bonds and hedge funds were the most short since 2018, I said, look, the odds of getting a third year negative in a row of bonds is very low, especially when they're this short. And we had one of the most rip your face off bond rallies in the following few months into year end. China, same thing, second most shorted in the Bank of America Fund Manager Survey. Hong Kong utilities, REITs, we took advantage of with CCI and Vornado. Vornado we harvested in the low 30s for more than a double, plus the options. It was a home run. Healthcare, we've got through biotech, which is starting to rip. Staples, we haven't found what we wanted to be cheap enough yet, but we'll keep an eye on that. Yen, I think this is going to be, for those of you into currency, I'd be long the yen, short the dollar. Dividend stocks, this is really interesting because if you look, DVY only gained 1.16%, 1.16% last year, which is shocking. And what's amazing about that, which is a group that I would want to buy, you could just buy the ETF. But, looking across, many of these stocks like Stanley Black & Decker, Generac, 3M, huge dividend grower, which, by the way, we haven't talked about much because they haven't reported earnings, but that thing's starting to move. What else has a dividend here? Disney will probably put one back. CCI, obviously, but that's also a rate play. Comstock Resources has a 5% dividend while you wait. Even Alibaba has a dividend now. You can't make that up, etc. So it's interesting that a lot of our big plays that we put in place are in this bucket that are now taking off. And I think this whole group is going to take off with rates coming down. Those dividends become more valuable. Looking through these assets, okay, so we covered that. Small caps, CPS, mid caps, we covered that a million times. Earnings growth for next year, the biggest growers are expected to be healthcare, communication services, infotech. We still have all of our Alphabet and Amazon. They'll probably perform much less well this year, but we kind of like them for the long term. Consumer discretionary. This is where we want to get some more exposure. And then we have VF Corp and a couple others. And then obviously sentiment changing for the dragon year in 2024 in China. Then you look at sector and industry group sequencing. So you had that peak in technology in 2022, early 2022, followed by the crash. And then when you get to the news cycle, China is where you want to start to bet, followed by emerging markets. And healthcare is now just starting to move. Canadian dollar is just starting to move. Small cap. So here's where we are in the cycle. Energy can start to move. Financials, etc. So there's some opportunity here. And then industry group cycles at the bottom of the cycle. Pharma. So there's a lot of cheap pharma there. I know some of you have brought up Pfizer and some of the others. Utilities, biotech, autos, et cetera, et cetera. So we're positioned across the board. And then plenty of room for equity allocation expansion. This chart here shows that the sell side indicator against a band of 60, 65. Okay, so since the great financial crisis, people have been so stuck in recency bias that the great financial crisis pushed stock allocations below the traditional 60 to 65% band. And it's basically stayed that way for more than a decade, the shell shock. But historically, these can go up to 60, 65%. And we're nowhere near close. So for everyone thinks that everyone's in too much on equities as a percentage of overall portfolio, there's still a lot of room to move here. Also further room for breadth expansion. The percentage of stocks that outperformed the S&P last year was at an anemic level below 25%. So this breadth is going to continue to expand. And then Fed minutes. Fed minutes suggest rate hikes are over, but no timetable on cuts. This is from the Fed whisperer, Timoreos. And so he says in his article, analysts found Powell's comments notable last month because he, quote, signaled more concern than he had previously about the risk of causing unnecessary harm to the economy by leaving rates too high as inflation falls. Quote, we are aware of the risk that we would hang on too long, end quote, he said. Quote, we're very focused on not making that mistake, end quote. Powell also repeated his view that officials could lower rates next year simply because inflation is well on its way to their 2% target. Holding rates steady as inflation falls would lead inflation adjusted or, quote, real rates to rise, which the Fed does not want. So as inflation comes down, if the Fed fund stays the same, real rates go up, which is restrictive. We're already 200 basis points too restrictive, as I discussed with Ali on Bloomberg HT. So, which the Fed doesn't want. Officials could lower nominal rates simply to prevent real interest rates from turning too tight, meaning match it 1 for 1. As whatever metric they want to use, core PCE or the metric of the day, as that ticks down 25 basis points on an annualized, bring down the Fed funds rate. And they do have to catch up because they're, probably getting closer to 300 basis points too restrictive right now. And then the final quote, which is extremely important, is, quote, "You wouldn't want to wait to get to 2% inflation to cut rates," Powell said. Quote, "It would be too late." So it's very comforting to hear that he actually understands that, because there have been many times over the last few years that it was evident he did not understand certain things. But he's got an opportunity here to go out as a star if he nails this landing. And the only way he misses is if he falls too far behind the curve on the easing, as he did on the tightening. And at this point, it's not even easing, it's reducing restriction, because we are in a highly restrictive stance right now with real rates. Finally, this shows the S&P performance at the start of Fed cutting is positive unless the economy enters a recession. If you look at the most recent GDP now, it's at plus 2.5%, earnings growth 12%. We're not having a recession. You don't get them in election years. And that's not to say anything can't happen. Anything can happen. But you also don't get once in 100-year pandemics in election years, but it happens. So leaving that aside, this is what everyone's focused on, the recency bias from the last three times. What they're missing, as I covered with Kelly O'Grady, was looking back a little bit beyond 95 mid-cycle, and the most appropriate comparison would be after the aggressive hiking cycle of 80 to 82. Once they started cutting, it led to an 18-year bull. I think we're already halfway through the secular bull, so maybe a 10-year bull from here. 8 to 10 year. I'm starting to lean on the side of cuts coming in sooner than later. You got the CPI report ahead of the January 31st Fed meeting. The big drop in the Fed's preferred inflation gauge, core PCE, now shows the average monthly change of the last half year is below the Fed's target of 2%. We're already there. It may already be too late. So I'm not betting on this, but I also wouldn't be shocked about the potential of a cut in January 31st. Again, I'm not betting on that. More likely they're going to push it off to March. But I think March now, I would say a week ago, I wasn't certain that was going to happen. I think March is a pretty damn sure thing based on the numbers, unless we see something in the inflation report that changes the facts. As we said several times last year in the podcast VideoCast, if real rates, Fed fund rate minus inflation stay too restrictive, we could have deflationary risks ahead, which are much harder to fix than inflation. A weak dollar and some commodity stability may hold this risk at bay, but the Fed may have to step in earlier than anticipated or fall behind the curve once again. An earlier cut will lead to further weakening in the dollar and a potential rebound in commodity prices in the coming year. And this was all similar to the stage in 2002, 2001 to 2002, which created the monster rally in commodities, small caps, and emerging markets from 2003 to 2007. So the table's set. You're seeing the rents now, the housing finally catching up. We've been pounding the table on that all last year. Used cars getting smashed, deflation grabbing hold of core PCE deflator, whether you look at video equipment, tires, phone and fax equipment. How many? There's a reason fax machine prices are going down. No one uses them. Games and toys, cellular, telecom. This is from the BEA. It shows how with the times they are. Telecom, foreign travel fares, railway, household supplies, and appliances. And the new bull market is in the early stages. The major advances from 1957 to date, cumulative return, excluding dividends. You can see most of them are at or near triple digits. We're only up 28%. So we've got a long way to go. Same thing you can see with the small caps, a lot of catch up to get up to the mean. That's from the Luthold group. And moving on to the goose is loose, ? So here we see those sectors outperformance that after the first Fed cut. So the percentage of time sectors outperform the S&P around the first cut since 1974. And what you see, the sectors with the two highest hit rates of outperforming the S&P after the first Fed cut are consumer discretionary, think VF Corp and Canada Goose, by the way, which we're going to talk about now, and energy, think Comstock Resources, which we talked about last week. On the Saturday before Christmas, Caitlin brought the girls into New York to join me after one of my hits. We decided to soak in the holiday spirit for a couple of days before heading back out to Connecticut to host Christmas. As we walked up Fifth Avenue, the girls visited their favorite stores, and I did channel checks on mine, North Face, Vans, which is VF Corp, and a few others. I was interested in surveying the, quote, consumer discretionary landscape, as that group tends to have the highest probability of sector outperformance following the first Fed cut. See above, which we just went through. That's the girls in the store. We showed that last week. As the girls and Caitlin took a turn into coach, I noticed a store called Canada Goose across the street. I was very curious because the stock had popped up several times in the last few months, but I always passed until I saw the line out the door. You had to wait on the street in the cold because there were too many people in the store, and security would only let in a certain number of people at a time. I waited for about 30 minutes until the girls came out of coach, and then I just left because there were too many people in front of me. It reminded me of Yeti, which also came up a number of times during the summer. The stock got down to $35 from $108, and I took a quick look. I saw a bit of growth deceleration, but it was still a cash-generative, high-quality business with some level of runway ahead. What I couldn't understand was who was buying $500 to $1,000 coolers to store their beer at a tailgate party. Isn't a cooler a cooler? On the way to attending the Cowboys game in Dallas against the Jets at the beginning of this season with a good friend and client, I spoke with another equity manager who had also noticed the stock and not done anything, but had a better grasp of the consumer who purchased these items. We were passing the parking lot and we saw these Yeti coolers and pickup trucks, etc. It was a luxury spend for people who wanted to show they could afford an expensive cooler. Yes, the quality and durability was probably better at the margins, but this was the Starbucks of coffee, the Apple of electronics, the Nike and Air Jordans of sneakers, the BMW of cars, the Rolex of watches, and the Coach of handbags. All perceived as luxury, but any aspirational middle-class person could stretch their budgets to show they had, quote, made it. I couldn't get there, so I passed. The stock closed the year at $54. Error of omission. I can deal with that. Maybe I'll get another look. Still not sure if I'd pull the trigger on that one. Maybe not. So this is Goose, Canada Goose. We've now established a new starter position in Goose in the last handful of days across accounts where there's capacity. We are likely a bit early on this one, and we'll have time to add into a more significant position over time. The number one thing that stood out for me on Goose was the fact that gross margins are expanding. You would never guess that by looking at the stock. So they've expanded from 52.5% in 2017 to 68.1% in the last 12 months. We're going to talk about how they're accomplishing them. You can see their cash flow per share, revenue per share have continued to grow since the IPO. As with earnings, sales top line has improved. The return on capital is solid, and they continue to grow revenues and compound shareholder wealth. The key to growing their margin is a 5-year, 3-point plan that they implemented in February of 2023. As you can see, it's going swimmingly because the stock is down from $25 down to $11. So that's working out great. But remember BYD, remember all the Peter Lynch stocks, et cetera, et cetera, et cetera. So at Cooper Standard, we bought basis about $5 and change. It went to $3.50. Or we started it in the sixes, went to $3.50. Our basis in the low fives on the initial batch, and then as we've added clients, every time we get a pullback, we get a chance to add. But the key to growing their okay, so here's the plan. By 2028, they are going to get to $3 billion of revenue with a 30% EBIT margin over the next 5 years. So they're basically going to do this through a few things, which would mean, by the way, they got about 100 million, call it $9 a share of EBIT. So let's just use like conservative round numbers. Let's just call it $6 or $7 a share of earnings At a 10 multiple is a $70 stock. At a 20 multiple is 140. But, just cut everything in half. And, you still got huge upside if they can execute. So the stock's down because they took guidance down in the most recent quarter. But they're still on track with their targets for the 5-year plan, which is also pretty good. Now, they're going to do this through 3 things. Number one, all right, so let's see. First off, this brand has been around since 1957, so it's not a fad. The son took it over. He owns 39% of the stock. That's Danny Reese. And they're religious about protecting the brand. So think the Hermes of jackets. Okay, so they want profitable growth, et cetera. It sounds a lot like PayPal, by the way. $3 billion in revenue, EBIT margin of 30%. 3 strategic growth pillars. Here are the 3 strategic growth pillars. Accelerate consumer-focused growth. Grow lifetime value of our long-standing and new customers with a focus on women and Gen Z. 2, build our DTC network. I think this is the most important. So they're basically going to cut back on wholesale, which is about 50% margin, and increase on DTC, which is their fancy stores. Think Apple stores for expensive jackets instead of Apple stores for expensive phones. And, or let's just put it, expensive high quality jackets, expensive high quality phones. So they're going to double their retail footprint from the 51 permanent stores at the end of Q3 2023, while continuing to grow their digital presence, both through omnichannel and online. See an opportunity in new markets around the world and expect to increase our DTC penetration within existing markets and will evolve our distribution structure in others. So what they figured out was the wholesale business, they can't control their brand as well and the margins are lower. And when they just focus on the stores in the super high-end areas, kind of like Apple, they get better margins, better sales, better sell-through, better control of the brand, better control of the customer, and higher margins. And that's why the margins keep going up, because they keep closing down, firing wholesalers, and adding stores. They just added in Atlanta, which is where I was over the weekend. They added in Philadelphia, I think near Villanova, whatever they call that area. It'll come to me. You guys know what it is. King of Prussia, I think it is, and Los Angeles. So, and then finally, create new and expand existing categories rapidly. We intend to deliver year-round relevance consistent with Canada Goose's position as a performance-like luxury lifestyle brand. We expect continued growth in all categories, including heavyweight and lightweight down feathers, and accelerated growth of newer categories such as rainwear, which is growing, apparel, and footwear, which is lower margin, but will be a small percentage of mix, as well as the addition of further categories, including eyewear, luggage, and home. In fiscal 2028, the company expects to achieve a revenue of $3 billion, representing a compound annual growth rate of approximately 20%, which they've done since the IPO. They expect to continue. Moving regional revenue as a percentage of total towards an equitable split between North America, EMEA, and Asia Pacific, 30% adjusted EBITDA margin, delivered through the disciplined execution of the strategy. Balances headwinds, maintain gross margin, favorable channel mix, pricing, and leverage of manufacturing overhead. Okay, to increase efficiency, reduce the direct costs of goods, improve sourcing costs, and leverage technology, among other things. Company expects to achieve $150 million in saved and avoided operating costs by the end of fiscal 2028, while focusing increased spend on the expansion of new categories and business initiatives. So, even though they brought guidance down this quarter, which, by the way, they brought it down because October second half tailed off. But if you remember, a lot of businesses got hurt in October because you had that Gaza thing, Hamas attack on Israel, and everyone was nervous. And there was another thing, student loans, repayments. And those two things hit the consumer hard. So I think they extrapolated forward from recency bias a level of uncertainty at this high end of luxury that may not have in fact showed up. And that was kind of reflected also on the call, that they did see some acceleration in up till the time of the call, which was, I think, November 2nd. But November and December were critical, and that's the name of the game. So, okay. So they expect DTC revenue to get to 80% of total revenue by 2028. When they IPO'd it, they had 29% of DTC. When you think of DTC, just think of super fancy stores on Fifth Avenue and Rodeo Drive equivalents, like Apple stores, and online, versus seeing a bunch of garbage stuffed into a Macy's and or a Nordstrom or something like that. Now, their wholesale business at the time, when they IPO'd in 2017, the lower margin stuff was basically the rest. So it was basically 70% wholesale, lower margin, inability to control the brand, and 29% direct to consumer. Since they've IPO'd, by the end of 2023, they expect to be 68% direct to consumer, and the goal is to get to 80%. So this looks like they're going to be able to do it, because they've already achieved so much of that already, and that's going to keep those margins up towards 70%, which is why you've seen the huge growth has been consistent from 52 to 68, with them moving from 29% DTC to 68% DTC, and that's going to continue to improve. Now, top line CAGR of 20%, $900 million of adjusted EBIT. Growth markets possess high purchase intent from non-Canada Goose owners. China is an enormous market, so the fact that they can do still grow 100 million top line this year, with China just starting to recover, is really great news. That's going to be a bigger and bigger thing, and you're seeing these luxury brands recover. Hermes is starting to recover. I think you'll start to see Estee Lauder start to recover in China in coming quarters, and they had some good things to say about it on the call. The outerwear market sizes across geographies, they talk about total addressable market, with China being the biggest, to double the US for their particular product. If you ever walk Fifth Avenue, it depends on different cycles in the market, but historically there are a ton of Chinese people. In the 80s, it was Japanese people. Now it's been Chinese people on Fifth Avenue. They just buy everything in sight. They love luxury, and they love high quality stuff. So they talk about the bridge, how they get there from new stores to e-commerce, etc. And it's a solid plan, and they're executing, and they're hitting on all cylinders with that. The new brands, the cost. By the way, they already achieved 10% of these costs avoided in this quarter. The reason their SG&A went up is because they had a lot of one-time costs associated with laying off 10% of their workforce to run the efficiency level that they want to run. So they can run triple the revenue with 90% of the people, because of the efficiencies they're working into the business. They also bought back a ton of shares. They've been bringing down the share count, which, by the way, if you see here, they're showing shares outstanding. Where is that? Yeah, 107 million. That's down to 103.5, by the way. They bought in a ton of stock in the last quarter. That is not the sign of management that feels uncertain about their future. As far as the quarter, their DTC revenue grew 15%. So they're executing. Where they missed, their wholesale revenue decreased, but that's actually part of the plan. Their weakest area, their revenue grew by 13% in Asia Pacific and 6% in EMEA. Where they got hit was in North America, which was down 7%. That was largely because they had the most abrupt change from reducing wholesale doors was not offset by the increase in retail doors that they anticipated. So that will catch up. And the SG&A costs were a big hit, 177 million, a lot of which are one-time in nature, which was also positive to see. So you can see a lot of positive things here. It was the U.S. wholesale that really hit things, but Asia Pacific, EMEA, where the future is, particularly in terms of Asia Pacific, are hitting on all cylinders. They repurchased 1.3 million shares for $29 million. And I like the fact that they brought on this for one of their collaborations. Annie Leibovitz did the photos, but they brought on Kimberly Newell, who is an Olympic ice hockey goalie. So that's obviously going to work because everyone loves hockey players. All right, so Los Angeles, Philadelphia, and Atlanta. Mainland China, they opened 2 more in Tianjin and Shanghai, and 1 in Tokyo, Japan. Permanent store count to 62 at the end of second quarter fiscal 2024. 12,000 new square feet. All right, so they guided basically to the low end of their range. They had been at 1.4 billion and 1.5. They're now 1.2 to 1.4. But with having done 1.1 last year, that if they got to the top, even if they get to the middle of their range, they are in line with the 5-year plan. So I'm not terribly worried about that. And I think they're going to wind up toward the top end of the range and surprise everyone to the upside, which is probably why they're buying in a lot of stock. So the DTC revenue as a percentage of total revenue was 70%. So they're almost at, their goal is to be at 80%. So they're doing it. They reduced the wholesale, which was their goal. 15. All right. So, and then you see Danny Reese, the son or the grandson of the founder from 1957. He's got 39.5% of the stock. Bain owns 60% of the stock. So, excuse me. Why are they saying it? I'm sorry, voting shares. Okay, I see what they're saying. Okay, so 40%. So they own, Bain owns 29.3. He owns 19.5%. But I guess there's a voting stock which has more votes, et cetera. So he has 35% of the vote. Bain has 54% of the vote, et cetera. All right, so the main reason that the stock is down, I mean, it's been falling since February, is they took the guidance down due to macro things. You never want to hear them talk about weather or macro conditions. It's all nonsense. But if you think about the context from which they were saying that in October, it does make sense because that did impact the high end in the short term, which we heard from a number of companies during that period. But they got more consumers came to shop with Canada Goose than in the same period last year. As the brand continues to capture attention shoppers around the world. DTC was up 15%. All right, so you can go through this. Chinese shoppers continue to be a driver of our growth, both inside and increasingly outside the country. As of Q2, we had 21 stores in China, position that we've got opportunistically backed by strong demand for our brand in this market, and knowing that this will position us well following the pandemic. Okay, 62 permanent stores. Covered that. They also opened one in Frankfurt International Airport. Cold weather didn't happen as early as they needed it to. Yada yada yada. You hate weather and macro, but it is what it is. They're still hitting on all the cylinders. We need them to get to fulfilling the 5-year plan, and the stock has punished them more than enough for the softer guidance. Rainwear was their fastest growing category in that quarter, which is new, which is pretty exciting. Canada Goose is first and foremost about our product. We don't compromise on our vision, being luxury leading luxury brand, which is defined by our product's high performance, style, and craftsmanship. Revenues were up 1% year on year. DTC sales grew 15%. Okay, wholesale revenue. All right, here's a key thing. We had especially strong performance in our stores in Hong Kong, in Taiwan, and in Macau, with the continued return of Chinese tourism. Store sales rose in mainland China, while lifting of COVID restrictions has led to a solid rebound in domestic spending. It's mind-boggling. If you look at all the headlines, the world is ending in China. If you listen to the businesses who are doing business there, it's completely not the case, and certainly not at the high end, which is, by the way, where Alibaba traffics is the higher end, not in that cheap shit that is unsustainable that Temu and Shine are killing themselves over. So EMEA was up 6%. Okay, Q2 gross margin expanded 410 basis points to 63.9. This was due to pricing and favorable product mix, even with non-heavyweight down outpacing heavyweight down, I might say, and a higher mix of DTC sales. DTC gross margin was 76% in Q2. Wholesale margins increased to 57%, which was up 620 basis points. But that was, I think they got a currency tailwind because of that, offset by costs and higher freight charges. SG&A spend, this is what I thought was out of control looking at the numbers, was $177 million. That was from the expansion of the network, but also the big part was one-time corporate restructuring expenses. They basically lopped off 10% of their sales force to run the business more efficiently, which is what they said they were going to do in February, and they executed. Bought back 1.6 million shares for $29 million. Good work. They've repurchased 3.7 million shares, or 68% of the amount authorized under the program. So we should see a new reauthorization in the next quarter, which would be nice. Now, by the way, if you look at the cash on the balance sheet, you're going to say, well, there's a reason why the stock is down. From 72 peak to $11, and that's because of the balance sheet. But what I would encourage you to do is actually look at it quarterly, because they get huge. It's very lumpy, their business, because they have to bring in all the inventory for winter, and you'll see that their cash goes from like 300 million down to 30 million, back up to 200 million. But you're going to see in the next quarter that it jumps back up from wherever it is, 29 million. It'll probably jump back up to 200 million. It's very seasonal in terms of their cash in, cash out. So don't be misled by that. And then we streamlined our corporate workforce, reducing non-store and non-manufacturing headcount by approximately 10%, resulting in a lean, centralized structure to support the next phase of growth. Savings run rate of approximately 15% of the 150 million Canadian dollars we expect as a result of our transformation program by 2028. And that progress is ahead of our expectations. So that's ahead of schedule. Good progress across our strategic pillars of our transformation program. Improvement. While we began to see some improvement in late October, just look up when the Gaza attacks were, look up when the student loan noise was, you're going to see that was in the early part of October. So once that headline nonsense was gone, the consumer got back out there and started to get excited. But they're talking on this call on November 2nd. That's why I think November and December will be better than they anticipated, and towards the higher end, which will shock a lot of people when they report. But we're not in it for quarterly reporting. We just want to see continued improvement towards the 2018 goals, which, if they're right, could be a monster bagger. So, okay, so that's that. We're running, wow, super on time. So look, sentiment is elevated as far as the market goes. Everyone knows that. We all know that. We've gone through what we expect and the roadmap and why we do what we do. Earnings, the IBD 50, the growth stocks, top 30 weights, estimates earnings power for 2024 is actually up 6.33% in the last 60 days. These are basically like the Momo stocks that ARK has. So all the stuff that's left for dead, earnings power is going up. Basic materials, same thing. The earnings are going down, opposite direction, negative 2.38. And I think we are ready for some Ask Me Anything questions. So, podcast is over. If you want to stick around for the Ask Me Anything questions, we'd love to have you. First one is, oh goodness, from Sam R. Hi, Tom. I've got a non-investing question. How does one approach finding the ideal partner or wife? Thanks. Gosh, that's the toughest question I've ever gotten on the Ask Me Anything questions. I think the number one thing that you want to focus on is become the type of person who would attract your ideal wife or partner. And that's just the way it works. You attract who you are. So if you want a great wife, figure out what type of person would you have to be a great husband, and you'll attract exactly what you are. So, I got super lucky. It's the most important decision you'll ever make in your lifetime. So I would just focus on, if you want a sensational wife with certain characteristics, then just ask yourself, am I a sensational potential husband with similar characteristics? Because like attracts like. And I think that goes for any partnership in business. We have never optimized here for maximum AUM. We have optimized for people we love to do business with, and we're excited to have as friends. We have smart people around us and like-minded partners that we wake up every morning super excited beyond belief to make money for them because we like them and they're people we would hang out with whether we had a business relationship with or not. And that's just how I choose to live my life. So as far as, I come from this strange philosophy, you can only eat so many cheeseburgers. After a certain level, it's just marginal advantages once you get over a certain hump. Which we're all for marginal advantages, don't get me wrong, but happiness and joy and fulfillment and working with people you love and trust and enjoy and get excited about making money for over time, nothing is more exciting. So as far as a life partner, just become the person you want to attract. That's the number one thing. John Lee, hi Tom, thanks for your previous answer regarding Kutera. It helped me to understand the risk involved. What are your thoughts on Q-Rate Retail? Before COVID, they were generating $800 million in free cash flow, blah, blah, blah. Yeah, I've looked at this one a couple of times, John. I think let's just take a look. QRTE. Okay, so wow, this thing has collapsed from $12 down to $1. So you got solvency risk. Let's take a look at how acute that could be. We got to get this a little smaller. Why is this not coming up? All right, so the revenues have been going nowhere. Let me just see here. We got $5 billion of debt. Let me just see here. I mean, all you have to do here. The only thing to do here is solvency analysis. And I've seen too many of these things go bankrupt. These low quality retailers. I personally like Cons and Aaron's and all them. I mean, they're just terrible businesses. Revenues are declining. Where is the... I don't know why it's not coming up on that. Where's the balance sheet? Let me just see your thing, because I don't have time to pull up the public filings. Debt is at fixed rate, $2 billion due by 2028 with $1 billion cash. Paid down significant portions of their debt load at discounted rates. Primary customers are older women who account for 75% of 1.5 million spending. High retention rate. Management has not made insider purchases. $2 billion. I mean, I'm taking your word on it. I would have to look on the publicly filed documents. I just don't know why the numbers are not coming up on this thing. Let me just see if it'll come up under another ticker. QR. So this company just merged with another company. I'm going to have to find another service. Oh, here it is. Okay, good. Now I have some numbers to look at. All right, so the revenues have been going nowhere. All right, $1 billion of cash. $6 billion of long-term debt. And I guess I would just double check your when that $2 billion comes due. I mean, looks like they might be potentially inflecting. It's just let me just see something here. What do these people do? Merge. Yeah, the other one that was like this, Chico's, that went bankrupt. Liberty Interactive Corp changed the name to Q-Rate Retail. Video and online commerce businesses. Oh, television shopping programs. Internet and mobile applications. Is this a John Malone thing? think this is a John Malone thing. So this is like the old HSN. I want to do more work on this. John, I think this is a crappy business, but I think you could probably make a 4 or 5 bagger if we can get the solvency thing down. But you have to assume there's a decent chance of bankruptcy. Leaving that aside, this might be worth a punt. I just have to understand the balance sheet a little bit better. So you're saying $2 billion due by 2028. They've been paying down debt. So this is like home shopping network, and I guess now websites attached to it. Their consumer base is dying off, which is why their revenues are flat to down. But I just have to also understand the growth story. Do they have something else to displace the declining TV business? But at a buck a share, and okay, so they have QVC, HSN, Zulily, Ballard Designs, Frontgate. Largest player in video commerce. 200 million homes through cable TV, which is kind of declining, but and they brought the share count down. I think this could be an interesting turnaround play. This is not a buy and hold forever, but I think you got something here. So just do the work on the solvency. And I think it's probably worth a punt. This would never be a 5 or 10% position, and probably not even a 3% position. But I would treat it like an option trade, maybe 1 or 1.5% of equity or 2%. And if you get a 4 or 5 bagger, that adds meaningful contribution by the end of the year. And if it goes to 0, it's not the end of the world. So I kind of like the risk reward. I would think about this as a long the way I think about puts as a short. It would need an EV of 3 to 5x. Willing to go to 0. If it works quickly and abruptly. I think all the components are there. Really good work, John Lee. Marcin Sees, love your podcast. The only thing about investing worth watching on YouTube. Wow. Okay. Thank you. Now to business. What do you think about PGRE, office REIT in New York and San Francisco? Solid. Balance sheet, insiders buying, 35% owned by Otto family and insiders, currently trades above $5. All debt is non-recourse. Unencumbered properties, 2 in New York, 1 in San Francisco. Cash is about $9 a share. Bought it at $4.50. Would still love your view. So I think we've said it a bunch of times. Like, we don't really, like, when we look for periods of dislocation, we buy only the highest quality assets in the most hated sector, which is why we played Vornado. I don't like the fact that this was just chronically declining before COVID either. That worries me. That tells me there's some shenanigans with management, that the market had no confidence. This is looking like a trade more than an investment. But let me just see here. PGRE. No. PGRE. Paramount Group. Okay. All right. Revs are flat. What is this from? Oh, loss on an investment of 39 million. So that's one off. Cost of goods sold. All right, let's take a look at the balance sheet. $3 billion of debt. $8 billion of assets. Huh. I think you have a trade here maybe, and just hit the bid at a double if you're lucky and get out. I don't know the properties. Fully managed to acquire high quality Class A. Okay, Class A office properties. Paramount's focus on max proven property managing high rent tenants. If it's legitimately Class A like Vornado, you'd probably be okay for a double. I think the question is, why didn't you get any real rebound in the back half of the year? But you're probably good for a double. But again, just double check on the balance sheet to make sure you're okay. I would never play there. I just don't like these smaller plays. Another friend brought me Hudson Properties, which again, I think that works as a trade, but it's all, and I think it's working for him too, by the way. And I never did anything with it. So yeah, he has a double already. Probably wind up with more than that. Really smart guy, but he's also a real estate guy. So yeah, I think, I mean, that's what I say when there are a lot of bargains still available if you do the work. I think these are some of them. These are not like Vornado. We took a quick double because the stock was up a lot, 100 to 125 depending on the account. The options were up a lot in a very short period of time. So we rang the register. I think that'll probably work its way higher over time, but the IRR changes from here forward. So sometimes you got to account for the time value of money. With some of these others, they're okay, but just treat them like options because they're not hold forever highest quality stuff. And size them accordingly. That's how you manage your risk. Once you're comfortable with the balance sheet. Wilhelm, Kuberger, and by the way, all these get saved if the Fed actually starts cuts in March or sooner, and these companies can all refinance and the capital markets open. All these leverage plays just are going to go through the moon. So I think your thinking is right. Bear. I looked at Bear. They've been around for 100 years. The problem is, unlike unlike 3M, I couldn't really quantify their legal liability risk with Monsanto, and they just lost another case. I would just need some understanding on the legal with Monsanto, and every time I looked at it, I couldn't quantify it in the way that I could with 3M, which is why 3M's working. So for me, I would pass because you're just basically guessing unless you can get some real legal quantification around that. Just move on to bigger and better things. But yeah, I keep looking at it. If I change my view, I'll bring it up, but I'm not there. It goes in my too hard box. And I think we covered that one a couple months ago too. But thank you for the question, Wilhelm, from Germany. So, hi, Tom. This is from Denise Cheshire. I appreciate your weekly missive and consider it must-see TV. I've shared your podcast with friends and family. Well, thank you very much. And by the way, if you're watching, if you can't afford to become a client, the best compliment you can pay is to share it with one or two people you know who would really benefit and really like the markets. The more you share it, the longer we're going to do this for non-clients, and I appreciate that very much. Dennis Cheshire, sorry. You often mention juicing your positions using long-dated options. I'm not sure if you've already shared or would be able to share some color regarding your strategy here. Of course, this is proprietary information. Just tell me to go jump in a lake. Realizing that you share opinions, not advice along these lines, and considering juicing as follows: long-dated 1 to 2 years out, slightly one option for every 100 shares. You often mention the benefits of using time arbitrage, not having to worry about gun to your head that arise when using leverage or margin. Juicing positions with options impinges on that benefit to some degree. Thanks for all you do. Happy to. All right, so I'll answer this to the extent. We generally own 8 to 12 businesses, which makes up 85 to 90% of the portfolio. And then with 10 to 15% of the portfolio, we'll have long-dated premium. And that's going to depend on a whole variety of factors and strikes, depending on whether the client is taxable or non-taxable. But to answer your question, we're willing to take that risk because the stocks that we're in, we wouldn't be in them if they didn't have at least a double upside. So if we lose on time, let's say the stock doesn't move for 1 to 2 years, which the options would expire, we've got like 9 to 1 equity to premium. So that would basically be like a 10% hit of capital to that position on the whole position, not on the portfolio. It would be, if it's a 10% position, it would be 1% equity capital or in that range. So all we lose is the magnified return. So let's say the double takes 4 years or 3 years and the option went to 0, but you're still up 100% minus on the equity minus the capital that you lost in the option. So it's not really a factor, but if it does work in that 2-year period, that double can become a triple in some cases, whether we're doing spreads or we're doing straight premium. And then the price based on the Greeks implied volatility. I'm looking for low implied volatility. And if not, I have to sell premium against the short premium against the long premium. So the long and the short of it is, I would suggest that takes a lifetime to learn. I would suggest reading the Macmillan book, the Green book, options. Let me just see. Options as a strategic investment. And then, yeah, that's the one. Options as a strategic investment. That's kind of the Bible. That's where you want to learn the stuff. Ekramor Roddy. Take a look at Archer Daniels Midland. ADM. We have said that we're interested in the chemical space. I think with this one, for us, it hasn't come down enough. I mean, now this is up 4x in the last 3 years. It's come in 10 or 20%. I know the PE ratios are low, trading at 11 times or whatever, but earnings seem to have leveled off. Cash flow seems to have leveled off. I think a lot of good news is priced in here. I'd be more looking at, if I had to be in the space, and I am looking at it, but I haven't done anything with it, is FMC Corp would be the better pick for me. It's just, I think a lot of the good news is priced in. Tila Tap, Happy New Year. Was wondering if you had any opinion on convertible bonds and what's your thoughts on CAPM and weighted average cost of capital. I don't like, it depends. I mean, show me the instrument. I mean, convertible bonds, I generally don't play there. There's usually a trade-off, and you give up upside, and I'm an equity guy, so I tend to avoid them. But if they're busted converts or they're dislocated converts and it's a way for me to be up a little further in the capital structure, I might get interested during periods of dislocation, but generally I pass. What's your thoughts on CAPM and WAC? I mean, CAPM, I wouldn't waste your time. and weighted average cost of capital, there are no thoughts. I mean, you just need a business that has a return on capital higher than its weighted average cost of capital to even take a look at it. That's step one. As far as CAPM, complete waste of time. We're looking for stocks that are in periods of dislocation, and beware of geeks bearing formulas because they're not helpful in the real world, unless you're running an index fund or something like that, or a closet index fund rather, which is a majority of active managers. Dave Margold, Tom was wondering if you had a preference to automatically reinvest the dividends for all these companies just for a select few, or take it all as cash. Thanks for taking my question. Keep up the hard work. Well, you get it as cash. I mean, the reason I take it as cash is because every single day I have to decide buy, sell, or hold this business based on what the market is appraising it at. And if the appraisal is double what my estimate of intrinsic value is, I'm a sell. And whether that's, so I'll take the cash from them and I will look at what business is giving me the greatest discount to intrinsic value. And chances are it may not be the company that's paying me the dividends. So no, I always want the cash. If that one is still cheap, I'll reinvest it. If it's run up a lot, I'll take that cash and use it for businesses that are just leaving the station. Not dissimilar for when new accounts are coming in. The reason we run as separately managed accounts versus commingled is because we often get a lot of money come in after we've had a huge run in P&L. And so we don't want to put them, like if you were to invest in a regular hedge fund, you'd be investing in all these positions after they've already run 100 or 200%, where you want to be investing in those companies and stocks that are just starting to leave the station. And that's what we love, is under the surface, we can find those businesses that are just taking off versus putting people in all the stuff that's already run. And that's why we've structured our business that way. It's very similar to Buffett's initial partnerships. He ran them all as single partnerships, moving forward with no management fee, and just he got paid for performance, a performance fee with high watermark, same thing we do. His clients got paid first, then he got paid, and then he had to earn back what he was paid before the split started again, and I just copied it after the greatest. So Ron Amchin. So I treat all cash the same. What is the best value per dollar today? Whether it's coming from dividends or new client deposits or whatever. On Alibaba's balance sheet, I broke down the investment line items based on the most recent annual report. What do you think? So he just goes through all these different things that we said already add up to about $67 billion of miscellaneous investments. Yeah, Ron, I mean, the good news is you did all this work. The bad news is it doesn't matter until it does. I mean, I can tell you that, your YTO, 23% of YTO Express worth $1.4 billion, you are not getting credit for that at today's prices. So it's good and useful information to have it. But the margin of safety is so great at this point that the granularity of this analysis won't matter until it changes. And then once it matters and the stock's at $150 and $200, then you need to start to take account for, okay, what is the market willing to pay for this position you got in the 70s or your blended 90s or whatever it happens to be, relative to the actual intrinsic value at a more than fair value price. And that's when this starts to come in. But for now, you're getting credit for none of it. So you don't really have to worry about it. Ivor Barry, Happy New Year, Tom. 2 names I have initiated are MPW and MO, bit of appreciation, turbocharged. Dividend income, what are your thoughts? I think we did MO the other day, but that's Altria. Yeah, I mean, it's basically a utility. It's basically like owning a bond. You get a high dividend that is growing, and you have some potential upside, and the sales are basically doing nothing for the last 20 years, and they just keep buying in shares. So it's better than owning a T-bill. So I will say that on that basis, it's fine, but it may go nowhere. It may go down. The dividend's probably good for a while. I think it's okay. I think they're better uses of capital, but I never buy a stock for the dividend. I think that's a trap. And eventually it stops working. Medical Property Trust. Yeah, I just got pitched a private deal that was bankrupt in Waco, Texas on this front. And I don't do private deals for the most part because the opportunities in public markets along with the liquidity are much better. But I was a hard pass on that one anyway. And this one, so huge asset write-downs, which means there are cockroaches. You don't know how much more they're going to have to write down. Interest expense going up. That may change this year. Revenues are declining. Shares outstanding are going up. I don't like that. Balance sheet. Yeah, you got to go through the balance sheet components. $10 billion of debt. They've got the properties marked at $13 billion, but how much cash do they have? $300 million. They're generating cash flow. I mean, this is pretty much the same trade as that PGRE. These are low quality things that you have to treat as options because they can go to zero, but you may get a good bounce and the thing could be 10 or 15 bucks, but you got to size it appropriately and you got to do really good work on the solvency risk, which takes hours and hours. So do your work. But make sure you don't have that overly sized because you don't need to take that level of risk. It's like Buffett says, what was the quote of the day today? Quote of the day was, I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. That's a 7-foot bar that if you get the triple flip and land it perfectly, you got a triple. But in the meantime, a truck may run you over. Hey, Tom, Paul Falcone looking at Fox FOXF. Aftermarket and performance brand for bikes and cars, trucks. They recently bought a baseball brand, Marucci. Not sure how I feel about that. Company looks good. Curious your thoughts. I think that one came across my screen the last couple of months and I did nothing. Let's see. Right, dynamics, bicycles. Yeah, solid balance sheet. Yeah, I mean, look, it checks all the boxes. I get a little worried about these that were like 20 baggers, and now they're kind of correcting because they can often do round trips. I would just, to your point about the baseball company, I would just listen to the last 4 or 8 calls. Everything here looks perfect in terms of the balance sheet, cash flow statement, everything else. But you got to understand the acquisitions, because you don't want a situation where 2 years from now you have an $800 million write down on the baseball company. So understand the businesses, understand how they fit together, look at management's backgrounds. But really go through the investor presentations, the annual reports, before you size into it. I'm not sure why I passed on this one. Probably because I already had exposure to auto suppliers, but I like this as a niche type business, but so is Polaris. I mean, Polaris is the OEM. If these guys are the only game in town, this is kind of interesting. So you just need to understand. So go through it, understand what they're buying and why they're buying it, and the history of management. How much do they own? Do they have skin in the game with you? But it's probably an interesting business to look further at. I'm going to take a closer look at that as well. Ivor Barry, Mobileye buy on weakness. Yeah, they had a bad quarter. MB. They were the poster child of the last hype cycle before AI, which was called, I think it was called Internet of Things. Okay, so they were only down 25% today. Right out of the gate, this business hasn't been operating long enough for me to get interested in, and I already own it through that trail that I have on Intel, which I think is a better way to play it. We took off 2/3 of Intel at whatever it was, $47, $48, after they realized full value for the PC and server business. Now we have a free tail of 1/3 on for the AI dream, and I guess the Mobileye dream, which is not happening. Let's just see here, MBLY. All right, MBLY. All right, well, I'll stop you right there. I'm not paying 15 times sales for a business that's been around for 5 minutes. So hard pass there. I own it for free through Intel, but let me just see here. There's cash, no debt, so clean balance sheet. Cash flow positive. Yeah, I want to own this through Intel as a free option. I would never own it on a standalone basis. That's just me. Happy to have a free option here, but no, I'm not going to go dumpster diving on this one. It's too speculative. So thanks, Ivor. So want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.